Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week. Hopefully, lots of great ideas and opportunities for you throughout the show. Well, the stock market continued its winning ways this week, mostly as it moved steadily higher all the way through Friday morning, and then all of a sudden things kind of changed as the market finally started to fall of its own weight and maybe being negatively affected by some earnings reports. Earnings overall have been really helpful, with a huge percentage of earnings beating for the second quarter. And then there's the occasional crater, as we saw Facebook and Twitter and Whirlpool. And Friday we saw also Intel moving to the downside, with overall the market really ignoring the negatives. Such is the way of a bull market. Much focus has been on the currency market, the Chinese yuan getting hit very hard, and that does soften the effect of the trade war that we have in the U.S. tariffs on China. China is trying to stimulate their economy, as it has been kind of getting a little slower, and all of that has been deemed as inflationary, and we've seen the bond market around the world start to move to the downside, and a little bit of curve steepening, but not all that much. Japan also just can't stand when they get an uptick in their interest rates. So they moved into the second round of buy everything day. In other words, you got it to sell, they'll buy it, because they just don't want to do anything to allow interest rates to go up. That is what caused the liquidity trap for the last 3 decades in Japan. We had that going on here for about 7 years here in the United States. Very low interest rates mean that there is very little in the economy that warrants taking investment risk, and then the money just essentially pools, and that's what they've had there, is a lot of money just going nowhere. So no matter how much they stimulate, it doesn't do anything. They'll be better off getting rid of Kuroda and Abe, and just getting somebody in there to lead that country out of this really poor policies that they've been in. As far as the United States go, the president cheered the huge GDP that, well, he thought we were going to get in advance, even before that came out, kind of a rarity. And actually, GDP for the second quarter up 4.1%. That was a slight miss. And the big jump of over 4% can be really credited to the trade war, as the tariffs or the threat of really pushed exports here out of the U.S., as they wanted to kind of beat that. In fact, soybeans, their exports up 50%. So we borrowed from the third quarter to get this boost that we had here in the second quarter, and that means the third quarter and maybe throughout the rest of the year will be much weaker. Tax policy certainly helping, so we're getting somewhat of a boost from that. But overall, I don't know if they're going to be able to get their year-over-year 3% growth they're looking for, because Q3 is going to come down pretty significantly, and people do know that. Stock market, well, big disparities that we're seeing in the market. We are in an up phase based on our work, and we are seeing the leaders that we had, like in the Russell, third tier of the market, really starting to flounder, and some of these bigger tech stocks struggling. So things do look a bit different. We think the market's okay actually into September, maybe very early October. We think the fourth quarter, though, is a problem for the stock market this year. And it makes sense with this 9-year bull market really needing to correct. So we think the momentum is still good. We're still seeing strength in the market outside of this decline that we're seeing on Friday. And we think that if we're right, and we do continue to see upside progress for the market, through September, it's time to lighten up. We think that there is risk here. Maybe we're moving into the midterms, and that might put some scare into the market. And maybe it's just that it's going to fall of its own weight because it's been up for so long and so far. Let's take a look as we look at our 60-minute chart of the S&P 500, where we can see what happened during the day, the news events, and look at that uptrend that kind of disappeared here on Friday. Pretty important to see that as we were moving up that uptrend right over there, look what happened as it broke down. We had like a 27-point decline in the E-mini S&Ps here on Friday. Here was some news here on Sunday that as the Chinese yuan broke very sharply, that moved the market down, as did the news that Elon Musk for Tesla wants rebates so he can show a profit. Rebates from his suppliers, pretty sick. Here the NASDAQ reversed on the upside, hoping for good earnings on Google, which it got, which lifted the market right over there. China rolls out a stimulus program right over here, gives it another boost right over there. And CNN released this Cohn-Trump tape, which these tapes don't seem to mean all that much. We got some sideways movement here on Wednesday. Then the news came out that Boeing and GM earnings were poor. That weighed on the Dow here early on Wednesday. But then the news came out that the EU Juncker and Trump have a trade truce, depending on which side you're on, left or right. They either see this as a big win for Trump because they're moving towards talking about zero tariffs, or a big loss for Trump because he folded essentially and backed off the tariffs. So I don't know which way you want to look at it. For me, any way you can get to zero tariffs is the way I want to go. Facebook here guides lower, and look at that here overnight, Wednesday after the close, the market takes a big hit. It tries to rally Thursday but can't hold. Amazon earnings here Thursday after the close, huge on the upside, but then that gives up most of those gains. And we got this gain here overnight, Q2 GDP up 4.1%. Inflation really looking mild at 1.8% year over year. So, that's not going to cause the Fed to get crazy in here because of that. And they know that we borrowed from Q3 to get that. And Intel and Twitter really gave their weight to the downside here in the market, and that's what helped get that break. So we had a pretty good break here on Friday, breaking what has been that uptrend that you can see for the entire week. Stock market for the week, S&P 500, actually looking here very late on Friday to be up less than 0.5%, just up a little bit. NASDAQ down a little bit, a fraction. Russell down nearly 2%, and the Dow Jones Industrial Average up 1.5%. So you can see the diversity or divergence that we're seeing here in the market. The bond market down about 1.25 points. Monday and Tuesday had big hits as the Chinese yuan got hit so hard. 10-year note up about 10 basis points on the week. The dollar just kind of small change, so I'll show you this just in a little bit, as it kind of just chopped sideways in a tight range. We kind of expected that. Gold down small, about $5, and the oil market up just over $1. We're going to look at the short-term view on that and show you why we think there is trouble in here for the oil market. That is a look at our short-term view for, at our opening for the show. And we're going to be right back, and I'm going to show you stocks, the best and worst for the week. All right, best and worst stocks for the week. I go through more than 300 stocks and take a look at what's some of the bigger move, best patterns, I think valuable information to you. Before I look at those, I want to remind you, follow us on Twitter at askSlim and become a YouTube subscriber. We'll put a number of videos up there, including this show. And give me a thumbs up if you like what you see here, because that helps us on our rankings on YouTube. So thumbs up would be helpful if you like this video. You can get our membership trials just by writing to me, slim@askSlim.com. And one thing I want to bring up to you really quickly, is our stock index report. We do a extremely involved report. We put that out on Thursday. We talk about all of our cycle analysis. We look at weekly, daily, and intraday patterns, show you all of our momentum indicators, our proprietary indicators. They're just great. We put all that on there and then write it all up, give you our analysis, tell you what we think is going on in the markets, and some very great graphic visuals that I think are really helpful as we compare the different three major indexes. All of that, which we also update on weekends when necessary, you can have for $19 a month. We're still in our initial phase on that. So if you sign up, you can have that for $19 a month. And you actually don't. You can get it for free right now, because if you write to our manager, our product innovation manager, Matt, he's going to send you a sample of that for free. Just write MATT, Matt, at askSlim.com. Ask him for the stock index report, SIR sample. He'll send that to you, and you'll be able to look it over. And if you like it, you'll subscribe for $19. And that really helps us, because we have a big team to support here, and I hope that you do that. If you're a member, of course, level 2, 3, or 4, that is included with your membership. So you don't have to do anything. You're already getting it. But for people out there that are watching this that are not members of our site or level 1 members, then all you have to do is upgrade, and you can get that, or sign up for it for $19, and you're grandfathered in for that. If you don't like it, just cancel it. But you'll see a tremendous amount of great information. So right to MATT, Matt, at askSlim.com, and ask him for that free sample of the stock index report. All right, so now let's look at the stocks we're going to look at in here. And the first one we're going to look at is AMD. Almost everything we're looking at in here has had earnings reports, so that's what we think are the biggest movers. Almost every big mover that we've seen has been based on our earnings report. So take a look here as we look at AMD in the technology semiconductor category. This stock is actually beating the pants off of Intel right now. They've got some really good new chips, and the stock is going up. You can see cycle patterns. That's the basis of our work that we do here, and you can see the beautiful rhythms that are here in this stock. You can see that as each advancing decline and declining phase falls right into these patterns that you see right here. Isn't that beautiful? And now we're in a new rising pattern, and it explodes up into and towards our target zone right up over here. You could see in here, if it pulls back into this buy zone, well, that's what we want to do, buy it. And we're anticipating it moving up here over the $21 area. So good earnings report, revenues beat, targets raised, analysts like it, and so do we. Up 17-18% for the week. Really nice. Corning Glass, GLW, another one in the tech category, and another one with beautiful patterns. Note the inverted head and shoulders in here. As you see, the cycle patterns form these. There's your left shoulder and your head and your right shoulder, and then the breakout, and there's your measurement. It gets right up to it and through it. Really powerful looking pattern. And as you can see, we're looking for a minor corrective period in here, and then moving up through that 35 area. So positive looking pattern in here, up 15% for the week on strong earnings and strong guidance. We call this a repaired stock. Why is it repaired? Well, it got all these beautiful positive configured patterns right in here, 5 of them, until it broke down right in here and then made the bottom, and now it's gotten above that 78.6%. So we will call that repaired. MPC is the next one we're going to look at. This is in the category of refiners. Now, this was the one that we liked the most. We said that if you wanted to buy one, it would be this one. And then in this intermediate support area, it's really good. I'll show you Phillips also, because it's very similar. And again, you can see the cyclical patterns, all positive right in here. Pretty nice decline right there. That's this decline, and this rally is right in here. The decline to support, and then the rally, and then it moves up. There's our target zone right over here. We expect that it will get up above the $86 number. there. So if it pulls back, we think it's a buy. Really great earnings in there, and analysts have been upgrading it. Take a look at Valero. You could see the same thing. This dotted line is because we had a little different pattern in here, and we thought it would extend out a little bit more, but it's very much in line with the rest of the group right now. It hits the support zone and then moves up. We're looking for 126 in Valero. PSX, you could see another one of those that looks absolutely great. Hits that buy zone and then moves up very sharply. We expect it to surpass that 122 high also. So that is a great look at the refining group, and they look great, just simply great. Eli Lilly, with the president out there attacking drug prices and the possibility for pharmaceutical competitions as far as retail sales by Amazon, and lots of things out there could be holding prices down. But then again, sometimes you just get one of them that just looks absolutely phenomenal, and that's what you have here in Eli Lilly. Very pretty cyclical action that you see in there, and it's now late in the pattern. So why do I say it's late? Well, you could see the minor pattern and the dominant pattern right here. So you could see a beautiful pattern right here. That's this. Right in there. I mean, that is super powerful when you get that. Then the next rally comes, right, as you can see right in here. But then it gets late and you get into the corrective period, as you can see. So the same thing happened here. It went up and then, well, it broke in a big way. So this was the corrective period. This was a corrective period, this one. See all those declines? And that's where we're getting right now. So it's too late to buy this one right now. And even though it's moving up a strong 9% on this big earnings beat, I wouldn't chase it here, would you? Next one, we're going to look at EXPE, Expedia. And there you could see we have very much highlighted the minor and dominant patterns that you can see. This is a great looking stock. We loved it down over here where we said it resisted this negative phase. You can see that note that we had right over there, and that it just exploded to the upside. We think it's going to get up here around 147 or so, maybe then go into this corrective period here, right like that. You can see these corrective periods bring almost no declines when they're really bullish. So could come up here, decline a little bit, and then spurt. We think it's going to get to a new high over 161 sometime later in the year. This is a very, very good looking pattern in Expedia. And one more we're going to look at in here is Broadcom. We warned our subscribers this week that Broadcom, AVGO, had some risk in here, and that we thought it was at a point where it could move to the downside. Look at that screaming head and shoulders top in there. Have you ever seen anything more beautiful? Well, maybe you have, but you can see the compound left shoulder, the compound right shoulder, the head, the neckline, and then the breakdown, and then the measurement way down over here under 160. Well, it could take you to the beginning of next year before you get down to 160, but it is a bad pattern. And here you could see there is a sell zone right over here because you have this negatively configured pattern we're looking at right over here that points to the downside. You see that? So it normally would fail in this sell zone. You see it's trying to get up in there, and then it pulled back. So it's tried a couple times this week. We actually think that this is an area where it's going to struggle, and we could easily see it moving back down here under 200 before you know it. So it could fool around for a couple more weeks in here, and it could get all the way up here to 234 if it wanted to. That wouldn't do anything to the negative pattern whatsoever, and we think that it is there we go to the weekly. It is a negative pattern. So earnings come out on 8/23 on that one, and we're suspicious based on this negative whole structure of patterns we're looking at here that those earnings could be bad. That is the best stocks for the week. Avago, a big gain, or Broadcom, 7% on the week, and we think it's one of the worst stocks. Take a look here as we move into the worst stocks for the week. For the worst of the week, down about 19-20% is a stock that we loved and then began to hate. And I'm going to give you a little more kind of deeper analysis in here on Twitter, as it just absolutely got hammered. And I want to show you why I put a warning out on here and why I thought it actually was turning negative. A little more advanced look here, and you can see as it moves down some 20% on the week. This big break. They removed 70 million users that had fake accounts. The earnings were, slightly, in line, but their guidance was very weak, and they say it's going to negatively affect it for a while. So what I want to show you here is a little more advanced. So here's your cycle rhythms, essentially, where we're looking at, where this low is pretty much on time right over here, and then you have this low over here, right over at that point. And then you could say, well, maybe this is the low as it comes down. Well, my analysis showed that this was setting up in a negative way based on what I reported on the 9th of July, that it was breaking down on the daily chart. So if I get a breakdown on the daily chart that says to me it's going to extend for longer, then in this case out into August, then I know that this is a big negative pattern that's forming in here. I'm going to show you that right here on the daily, that you can see right in here. This engulfing pattern, this violation right there said to me that this pattern right in here, the bottom came, and then the rally came, and then the breakdown came, which points to a decline way out over there. So when you have that kind of a pattern where the shorter term pattern predicts that it's going to go out till 8/25, August 25th, plus or minus about 3 days, then you can go back and extrapolate that out over here onto the weekly chart, and that says that, well, if your short-term pattern is going to decline all the way out until about 8/25, right out over here, then you're likely to get some kind of a bounce and then move out again or down again into late October. So this is really ugliness when you look at this, and I think the sum of the evidence says it's in trouble. You now have a downturn in this intermediate momentum indicator, the whole moving average, and everything about this says that Twitter has got problems for long term. Talk about problems. Look at this pattern right in here in Facebook. That is, again, signaling that it's got a long time to fall. On yesterday, on the 26th, we projected that the cycle low would be between September 5th and 10th, and that the price projection was right over here, as you can see, about 164. So this is what we expect to happen, and if it tries to rally in here, we think you sell it, and it's likely to move to the downside again. Facebook down some 18% on the week, massive top, just shocking from that new high, as the guidance was really weak, revenues missed, and a lot has to do with the costs, big increase in costs on their data and privacy issues. So that's pretty bad. Take a look at DDD, which is 3D Systems. This stock, no real news, corporate news, other than the fact that, well, Amazon's coming out with 3D printers. And between that and the Hewlett-Packard competition, we think that what essentially we've had is a bear market right in here, and then simply a bear flag going on right in here. We think this stock is going to move down again, and this is just the beginning of it. Low projected out into September in here, and that's a bad looking top as it gets into the target zone, fails at the major 50 right over there, and then turns down in a very sharp way. So we talk about doing cycle analysis, which are essentially the rhythms of the market, the heartbeat in the market. And this next chart I'm going to show you may be one of the classics in here, because it really highlights the type of work that we do and how much great information you can get out of it. You might want to watch the analysis on this chart a number of times, and then make sure that you go to our site, to the top navigation under workshops, and go review the information on our cycle analysis workshop. workshop, you may really want to take this and begin to learn this type of analysis. I've been doing it now for 42 years, just an amazing long period of time. I've been trading for 44 years. So this is a chart that you're going to want to see and review. This has our cycle analysis and our swing high, swing low analysis in here, and I'll show it to you really quickly. So here's your cycles. You can see that it says that, you know, you're a rally phase and sell-off phase. That's one is a little off, but this one is kind of spot on. You can see that one, and this one, and this one. Okay, so those are your cycles. That gives you a sense for the rhythm of the market, when you're going to make cyclical lows or potential troughs, or when you're going to make peaks. And peaks, we get a lot of information from candlesticks like that engulfing in the target zone right over here. Note the positive configuration. That's that upward trend line that you can see right over there. It hits the support buy zone based on our swing high, swing low analysis. Odds are it's going to get above this high, and it does. But then when it gives you this negatively configured cycle, it says that rallies will fail here in the resistance zone. Negative cycle, fail in the resistance zone. Negative cycle again. And here's your new resistance zone. It happens to be declining because we don't really have a bottom yet. And that is a picture of a very negative stock. I don't know. They had hoped that they would get some benefit from the tariff situation, helping them out. It's really not. And this is really bad. Down 15% in the week. Earnings missed. Analysts all over it, downgrading. And this is a perfect cyclical analysis lesson right over there. That's all the stocks that I'm going to show you right now, but I'm going to talk about a couple of more groups right in here. The home building stocks, well, they're suffering from the prospect of higher interest rates. Sometimes in other cycles, interest rates going up at the beginning of that cycle, they like that because then people rush to buy homes before the interest rates go up. It's not going on at all in this particular cycle. Beazer Home, really bad earnings, down 18% of the week. Pulte Home follows it, as does KBH, down 10%, down 9%. Lennar down about 5 or 6%. All of those in declining phases look like August, September, and then probably bounces after that will be minimal. And the auto stocks, Ford, GM, both down about 5%. You'd think they do better under the conditions of the trade war, or maybe calming down, but that's not the case. The earnings really showed a lot of weakness. And then there's Tesla, which Elon Musk, you never know what this guy is doing, and recently it's been nothing that's been good, as he's begging for money from his suppliers to be able to get a profit. Supposedly thousands of cars sitting on lots, and a total of hundreds of thousands of early people that put in deposits to get $35,000 cars that have not yet been produced. And also their subsidies are running out and now cut in half based on getting past the 200,000 car number. So there's nothing good about it. Target in there, 272. You'll get a day or two or something where it moves up and the shorts cover because there's massive shorts out there. We think those are selling opportunities if that happens. 272, our best target right now. We think it possibly could be lower than that. That is a look at the worst stocks for the week, and stick around in a minute or less. I'm going to show you what our short-term view is for the coming week. All right, short-term view for the coming week. Do this every single week. We take an accounting of how we did in the last week. We did pretty well this week. We're going to call it about 70%, as the cyclical patterns were very strong, and pricing was where there was maybe more weakness, as the some of the moves on the downside were a little bit bigger than we expected. That was especially the case in the bond market. Let's start out, as we always do, in light crude. I said in the beginning of the show that I was going to show you something that the reason why I think that light crude is going to move to the downside. And so we're going to look at a chart that I showed last week with a little different look on it. And I've been showing this in my Future Speak show on Wednesday. Don't forget, on Wednesdays I do 24 different futures contracts, really extensive analysis. It is our most popular video, and you will learn a ton about the correlations of the markets, 6 different segments of the futures markets that we look at. Here is light crude on that daily chart. So you'll notice those yellow highlighted areas. Those are areas where there's a nesting between the dominant and minor cycle pattern. So it brings a decline, and it brings a decline, and right in here, and that's where we are right now. So I want you to note that where we are right now is what looks like a bear flag that's formed right in there as it rallies up into the sell zone. That's why we informed our subscribers this week of a potential setup of a favorable area for a move to the downside. That's always around percentages, and we believe that we get up around 60% probability of being correct under these conditions, and more like about 32 or 33% incorrect. So it's a very good ratio, and this third minor cycle that you can see here into this nesting area brings a high likelihood of getting a move to the downside. So we think that is a reason to believe that the short side trade is the one that makes sense. For the week, we're looking for this downside move. Note that momentum in here is about neutral. It isn't really doing much in there. We have, a couple of targets in here that we're looking at right now. This one right over here, which is that 65.30, is an important number right over there. This low right over here at about 66.30 or so is an important number. So those are kind of the numbers we're looking at, 65.30, 66.30, and we think that will come over the next 5 to 7 trading sessions on the downside. So that's the highest probability of what we see in light crude. Last week we thought it would come up and test this zone and then begin to roll over. It did that, though it hasn't really gotten down into any significant kind of decline yet. But if it breaks that flag that you can see going on there, we think that it will. As far as the dollar goes, /DXY, the dollar and the euro both move sideways, and we kind of thought that would happen this week. We thought the dollar would be down a little bit for the week. It's right around unchanged. You can see that. We thought the euro would be up a little bit for the week. It's right around unchanged also, and we actually think that it's probably going to be the same type of read for this coming week. You can see a small down that we think is going to be in here for the dollar. Momentum neutral. There's really not much to read in there, so just a small down move in the dollar, maybe getting back down to that low area of that support in there, which is right around that 94.13 area for the dollar. For the euro, if you trade that as the inverse, as a proxy for the dollar, we're looking for what could be a small move to the upside. And here there's a VTL coming down. If it breaks through there, you could get a little move up to 118.5, but overall a small move to the upside. Then after that, essentially what we think is going to happen is the opposite. So you get a move to the upside here that's minor. Then you could get a big down move here in the euros. That's a little bigger look. And the opposite that we see here in the dollar that we think will have this minor period where it moves down and then a big up move that you could see right over here. So again, maybe 5 to 7 days of decline for the dollar in a minor way, and then the odds are pretty good it's going to be moving to the upside. As far as gold market goes, we thought that it would let's get that chart up here first. We thought that the gold market would have a small week, that it would rally and then roll over. Our notes essentially said that it would move up into this area here and then move down, and that's exactly what it did. We thought it would get up into that resistance zone, 1239, 1249. That's exactly what it did. And now you can see it's pointing to the downside. Remember we said the dollar likely could move down a little bit and then move up. Well, maybe this moves up a little bit and then moves down. Tends to move inverse to that. So overall, we think the risk is to the downside here, and we'll begin looking for gold to move down into these areas of support, 1220, 1208 right over here, and that's a reasonable expectation, if not moving down more than that over the coming week or 2 weeks. We'll call it a minor chop to the downside. A momentum here still clearly negative. You can see that in the slim ribbon right here. Momentum started its negative trend right over here when we saw it up around 1330, and you could see this decline in negative momentum all the way. You can see that in the colored bars over here on volume. That's your negative momentum also. That has taken it down over $100 an ounce in that momentum phase. Slim ribbon will never miss one of these. It signals it, and if it stays in negative momentum, you will see it very clearly as the slim ribbon becomes a resistance zone. You can see it, and the opposite when it's moving to the upside. So put that on your Thinkorswim platform if you have that. So let's take a look now as we switch over and look at the bond market /ZB. That's not ZB, /ZB. There you go. So here you could see what we thought that the bond market would do would be to move down and then maybe move up towards the end of the week. Well, that's basically what we got, though the downside move was a little harder, but into the support zone. And the upside move, it's just trying. You see, it's not really able to do it. If anything, it's just getting stability. So we think that a bounce after what we think is a significant intermediate peak is about to occur. Here's the target area up here. We'll call it's really about 143.30 over the next 5 to 8 trading sessions. That's a sell zone for us if it does happen. We think the odds are it will move down again. For those of you that are our chart subscribers or following cycles, because of the yield curve changes, the 10-year cycle and the 30-year cycle are out of phase right now. So we'll be looking for this bounce, but we don't trust it, and we think that it will be a minor up week and a short selling opportunity if we do get that. So let's talk about the stock market now. The stock market analysis for us is changing a little bit. It's based on weakness in the Russell, based on weakness in the NASDAQ that is extending, and it's changing our patterns a little bit. So for those of you that are getting our charts and stock index report, you'll see we're going to send you new chart grids over the weekend, and also be updating the stock index report. Don't forget, if you don't get it, you can get a sample by writing Matt at askSlim.com. So let's take a look now as we switch over to the stock market. I'm going to show you really quickly the Russell, RUT, which I normally don't show right now. And I want to show you the extended pattern that's going on right over here as it moves down into support area. There's no danger in here in what's happening. It looks like it's extending out and lengthening. So what we had to do in the S&P 500, well, let's take a little look at the NASDAQ also. So you can see the same thing really happening here in the NASDAQ. And you can see these blue dotted lines right over here as we extend out the projected cycle right there. It's likely we're getting, because of the shallowness of this decline, that this is all one pattern. And so it's likely that it could go down another day or so, but then I think we're going to start to move to the upside. So if I extrapolate that and put it into the S&P 500, you'll see that the S&P 500 is stronger. You can see that it has this inside down pattern in this area of fib extensions. That essentially says to us that that's an important area. This top that it made right over here at about 28.48 is going to be kind of a tough area. And here you could see this resistance, little minor resistance zone. We think that is setting an area where it's going to have, at least for the very near term, some problem getting on the upside. The other part of that is that the supports in here right around 27.94, 27.87. We kind of think those are the area it's going to hold. So we're calling for that range, really top of this about 28.35, 27.87 is kind of the range for the week, and we're kind of looking for a small change. Why would that be? Well, a little bit down in here, a little bit up in here, and not big changes. So this could be a week we see some range trading in here in the S&P 500. This again looks like it's extending out, and when I look at the cycle counts in here, I want you to note the notation in here that this is a 20th day off off of this low, which was lengthening at 22 days. They were 22 days here, a 17-day cycle here. So we identified some of the longer patterns in here. And so that says this one maybe another day or two, and then moving back on the upside. It's not damaging. There's no breakdowns. You can see that the positive momentum is still in existence, and it held right over there on the slim ribbon, right in the 13-day moving average. Everything about this still is bullish. So no matter what you want to make of this pattern right in here, it just looks and feels to me like a temporary stopping point. But when we get the next rally and we see how it acts at 28.48, we'll get some sense whether or not it's going to try to get up here to these top fib extensions and that old high at 28.73. So overall, our projections are for tighter ranges in here, and we'll have to see if the market can gain anything. On future speak this Wednesday, we're going to have more clarity about this, and hopefully we'll be able to make a little stronger sense of what's going on. Right now, we're just calling for that range that we're talking about in the coming week. That is a look at the stock market, the S&P 500, a peek at the NASDAQ and the Russell, and everything we're going to show you today. I hope you enjoyed everything that you saw, that there was something of good value for you. I just suggested a lot of things for you to do at the askSlim site. If you're not a member, you really want to support us, you want to learn about some of our work, you will learn a tremendous amount from that stock index report. Write to matt@askSlim.com and ask for that free sample. And then if you want, you could sign up for $19 a month, and that will really help us, and the whole family will grow, and you're going to learn a ton. So I really hope that you do that. That's it for the week. I want you to be really careful because it is so crazy out there. We're always wishing you great trading.